The price of AT&T stock has been plummeting ever since the news that they would be spinning off Warner Media and merging it with Discovery, along with cutting their dividend payments in half starting in mid-2022. This was devastating news to most dividend investors and has caused many investors to sell out of their AT&T positions over the past few months. The price has reached its lowest level in the past 10 years, and AT&T stock is currently continuing to trend downward on a weekly basis. So as a dividend investor, this brings about an important question. Is now the time to look into buying AT&T stock? Warren Buffett is often quoted saying, "Be fearful when others are greedy and greedy when others are fearful." Take a look at what he means by this.
Let's talk a little bit about the fact that the market's down almost 800 points this morning.
Yeah.
Concern for you?
Well, no, that's good for us, actually. We're a net buyer of stocks over time. And just like being a net buyer of food, I expect to buy food the rest of my life, and I hope that food goes down in price tomorrow. So when stocks are down, we're going to be buying on balance, and who wouldn't rather buy it, at a lower price than a higher price? People are really strange on that. I mean, because most people, most of your listeners are savers, and that means they'll be net buyers, and they should want the stock market to go down. They should want to buy at a lower price, but they have that feeling that they just feel better when stocks are going up.
This strategy is a great way to make phenomenal value investments that can outperform the market in the long run, but this quote is often taken out of context. Many people often take this quote as an excuse to blindly buy the dip. This strategy may work at times, but it can also cause you to take on major risks, which will eventually cause you to lose much of your investment. So what did Warren Buffett mean when he made this famous quote? This ties back to finding the intrinsic value of a stock. Stock prices fluctuate up and down for a different number of reasons, but calculating the intrinsic value of a stock is the best way to know that you are purchasing a stock at a great price. Take a look at this picture here. This picture makes it clear how buying a company that is undervalued as compared to their intrinsic value is a great way to make solid value investments. There are a few different ways to calculate the intrinsic value of a stock, but one of the most popular methods is using a discounted cash flow analysis. A discounted cash flow helps determine the value of an investment based on its future free cash flows. Using a discounted cash flow analysis can help us to determine what the intrinsic value of AT&T is. As you can see here, I have already built out a discounted cash flow analysis model to help us find the intrinsic value of AT&T stock. In order to perform this model, the first thing I needed to do was find the future growth rate of AT&T's cash flows. So what I did is I took the prior 5 years free cash flows and averaged those growth rates, and I took that into consideration when trying to find the future growth rate, as well as taking into consideration the reduced payout ratio and also AT&T's new focus on its streaming services. I then used those numbers to project the future free cash flows of the company as well as the terminal value. The next step was to discount these cash flows back to their present value, which you can see I did right here. I then took the sum of these future free cash flows right here and added the cash and cash equivalents and then subtracted AT&T's debt from those. You can then see we were able to find the equity value of AT&T, which I then divided by the number of shares outstanding for AT&T. This led me to find an intrinsic value for AT&T of $31.82 per share. Based off of our discounted cash flow model, we may come to the conclusion that AT&T is slightly undervalued. Another popular way to calculate the intrinsic value of a stock is by using the dividend discount method. The dividend discount model is used for predicting the price of a company's stock based on the theory that its present day price is worth the sum of all of its future dividend payments when discounted back to their present value. So this is typically a method that is only used for well-established dividend-paying stocks. As we can see here, I have already built out a dividend discount model for AT&T. I started this model with the year 2022, since this is the year that their dividend payout will be sliced in half. I'm projecting a dividend payout for each quarter of 26 cents per share, meaning they'll have a yearly dividend payout per share of $1.04. I'm assuming a 4% increase year over year, which will mean that the average growth rate for these dividends is 3.64%. Making the assumption that there's a discount rate of about 9.5%, we can see that the dividend discount model finds a price per share of $21.23 per share. One downfall of the dividend discount method is it's very dependent on the growth rate of future dividend payouts. For example, If I were to come and change the quarterly dividend payout growth from 1 cent to 2 cents over the next 5 years, you can see just how greatly this affects AT&T's stock price. This model is difficult to use to project AT&T's stock price since we do not yet know what their management's philosophy will be in regards to raising the amount paid in dividends. So, with all of this being said, is AT&T stock worth purchasing for dividend investors? Based off of our valuations, it would appear possible that AT&T stock is currently slightly undervalued. AT&T will likely be able to continue to slowly grow its cash flows from its telecom and media business for years to come, allowing them the option to make larger dividend payments in the future. Are you going to be buying AT&T stock? Let me know your thoughts in the comments below. Thanks so much for watching the video, and please don't forget to like and subscribe to the channel.